what drew my attention to the LBMA, and I've likened it to the tongue in cheek to the reactor core of the Death Star, but it really is the center of the price fixing scheme that has been used globally now since its creation in 1987, and has been used to attempt to subdue the price and the price action of gold and silver, allowing this global debt bubble to be blown by the central banks now for approaching 40 years.
Monaco 64, home of alternative economics and contrarian views. Well, today I have a very appropriate guest seeing what's going on in the silver market and the bullion market in general. I've even created a playlist for him on my channel. It's David Jensen. And the playlist, if you want to look at it, is David Jensen on the LBMA. And we are talking on the in the evening of the 5th of December, evening in London, morning in British Columbia, where David is. David, welcome back. It's been since October since the last time we spoke. Nice to speak with you again.
Yes, indeed. It's great to talk again. I look forward to this, Mario.
Yeah, me too. And just to give the viewers an example, because I think David is like out of all the analysts out there, and you can find his stuff on Substack, Jensen David on Substack. I highly recommend that. But he, in my opinion, knows about the LBMA or the London Bullion Market Association better than anyone else. The first video we did back in September 2024 was entitled "The London Bullion Market Has Sent Gold and Silver Supply to the Moon." He also said back in March this year, an absolute, and I quote, an absolutely massive fraud that has been perpetrated for decades. And that's the mechanism through which the LBMA trades. David, and maybe you could touch upon that briefly, and then we could talk about what's going on now with silver and the LBMA and COMEX.
Sure. Gold and silver, Mario, are real physical assets. And so what drew my attention to the LBMA was that it's the world's largest physical exchange for gold and silver. It puts itself forward as that, and we can see it in the trading volumes for these cash contracts, which are more than 90% of the gold and silver trade in London. So that is what drew my attention to the LBMA, and I've likened it to the tongue in cheek to the reactor core of the Death Star, but it really is the center of the price fixing scheme that has been used globally now since its creation in 1987, and has been used to attempt to subdue the price and the price action of gold and silver, allowing this global debt bubble to be blown by the central banks now for approaching 40 years. So that is what drew my attention to it, and the issue in particular in the silver market is these promissory note cash contracts, which are for immediate ownership and immediate delivery, are the heart of the issue. And London, the LBMA tells us that they're trading 700 million of these a day, and that speaks of an open interest of the order of about 2 billion ounces that is standing in the market. And I've got to say that for all the mainstream metals analysis that I've read over the years, I don't think I've read a single major investment company or a single bullion bank which has commentated about this structure, which is the nub of the entire issue. The fact that there are billions of ounces of silver standing in the market in this promissory note market, and yet, the bullion banks are very good at calling tops in the prices of silver and gold. And we've seen that at 28, 38, 48, now $58, they're all calling for tops. And I don't see that as likely. And given the fact that my view is that the paper markets in general, bonds in particular, are on fire, I don't think it's possible at this stage.
Yeah, and the last time we spoke, you said that the demise of the LBMA silver promissory note scheme would mark the end of the fiat currency regime. And I don't know if, well, you probably saw what happened last week
Yeah.
on the session. Uh, yeah, like Thursday night session after Thanksgiving and Friday morning in London, they closed the market. They said it was some kind of glitch in the cooling system. But
Hmm.
I mean, I've heard from sources that like central banks were major buyers of silver futures and were asking for delivery. And we saw on COMEX, that is, and we saw also JP Morgan withdrawing like I think 13.4 million ounces of silver from the registered to the eligible category, which basically means they've taken the silver out of the market. So it seems to me that this paper game is coming to an end. I mean, as we speak here on Friday, it's like 5 p.m. London. Well, silver made a new all-time high spot market, 59.35, about an hour and a half ago or so. And then and gold got up to like 42.60, and then you could tell, watching the tape that someone was coming in selling, well, bombarding the market with paper. It just seems to me that they're desperate, but all this is going to do, I think, David, and I don't know if you agree with me, when they smash the price down like this, the people who want the physical and who know what's going on in the LBMA and COMEX, that it is a fraud, and they're gonna go and buy the physical. So right now, silver's at 58.50, which is still up 2.3% on the day. So just yeah, if you first question is about the silver and the fiat currency regime, and then the second one, what's happening today and how you see it going forward.
Yeah, okay. Y- when they shut down I think it was the Globex market that was shut down, right? The COMEX, the CME's
Yeah, that's
overnight
right.
trading, right? And it wasn't clear to me whether they said that it was their price cooling system or the cooling system of the computers, which was not working properly.
Yeah, yeah, I think the price cooling, that's a good one. And just want to add one thing, David, because I was a futures broker for 20 years and I remember trading Globex back in the 90s, and it was a much more primitive system. And we had the Asian crisis back then and loads of stuff. And I never remember the market like having to shut down because of activity. And here we are, you know, uh, 30 years later, and we get a glitch like this. Anyway, I'll let you continue.
Yeah. No, it's quite incredible, 10 hours. Um, I noted there a few days ago that we saw UBS came out with a new silver deficit estimate next year of about 300 million ounces in round numbers, about a 1.2 billion ounce market, right? So about a 25% supply deficit. And I think it really, and this is why I think it's so impossible to be calling tops right now, given this structural deficit that we have in the market. And I guess that to get to the very root of it, we have to look at the structure of the capital markets in terms of the scale of what we're dealing with. And if we look at, the global bond market, it's about $145 trillion. And if we look at the global equity market, market cap is about $125 trillion. So together, we have $270 trillion of wealth, if you want to call it that. in these markets. And the new bond issuance every year, because some of these bonds reach maturity, they have to reissue new bonds. But the debt and the bond issuance every year is about $27.5 trillion a year. So gold and silver are natural competitors to bonds, I would argue. As they were in the 70s, we saw the selling of treasuries, of these certificates of confiscation, and the buying of gold and silver, and the forcing up of interest rates as a consequence. But I think if we look at the scale of what we're dealing with, the continued deficits going forward, and then we look at like total silver supply to the market is about $80 billion a year. And going back to that number of total debt issuance every year, it's about $27.5 trillion. So that's $27,500 billion a year versus 80 billion a year in silver issuance, right? Silver supply, pardon me. 80 versus 27,500. And it's that enormity of the scale difference that we see that speaks to the continuity of really what has become a compounded problem or a compounding problem that we see. And so kind of these celebration laps about, more silver is coming into the market. It is creeping up. But what we're seeing really is a linear increase of supply coming to market of silver, but an exponential demand increase potential at the least, right? So on one side, you've got an exponential problem, and on the other side, you've got a linear gradual solution. And the mathematics of the two just don't add up. The math doesn't work. Why we're seeing these desperate attempts to slam it because the interest is growing as people are starting to smell the bonfire, BOND fire that's going on out there, and they're thinking, maybe it is good to have something that's nobody else's liability in hand.
Yeah, and the numbers you touched upon there, the is that 30 billion for silver?
Sorry,
You,
80 billion a year of total
yeah,
supply.
yeah, 80 billion and then 27 trillion of new debt. I mean, the new supply of silver is like a drop in the ocean compared to
Right.
the new debts.
Yeah,
And
and even gold is what is it, 630 billion a year of total supply, so less than a trillion of
mm,
total supply.
yeah,
And
yeah,
just the issuance of the bonds a year is 27.5 trillion. And that doesn't even account for active selling of equities and bonds, and then the purchase of some of these durable, enduring real assets, right? So you've got $270 trillion. I mean, the numbers are just, we should probably stop talking about it because they're just so large, but 270,000 billion of total paper assets out there. And this is the imbalance, which there's just no solving the problem. And there's no 28, 38, 48, $50 top for silver because the reallocation has started and we're dealing with things that just don't work together. One is exponential demand and the other one is linear supply. And that's where we're at, quite frankly. And it's where you would expect to be. It's where you would have known you would have been in 1987 when they started promoting this unallocated market. Is that you can fix prices of goods for a period, but in the end, you guarantee collapse. And so this was a known policy choice back in the 1980s to embark on this
yeah,
path.
yeah. And interesting that it was right around the time as well that Greenspan took over, and he
Yeah.
he was a master of manipulating things, I would say.
Well, he admitted in private conversations that they were going to try to thwart the next downturn by loosening monetary policy. But if they failed, his comment was that the results would be much worse than the Great Depression.
Yeah. Can you explain?
Sorry, just to
Yeah.
interrupt,
Sorry.
you. But there is a book that was written called What Alan Greenspan Really Thinks. and it was a speech that he gave in Brussels. It was written by Larry Parks.
Oh, I know. I remember Larry Parks. I met him once, actually. Yeah.
You know, he's a lifelong sound money advocate. And so I highly recommend. It's been a while since I read the book, but it was he gave the speech at a university in, I believe, in Brussels. It was in Belgium. Um, Gave a speech, and knowing that the financial press wouldn't be there, he spoke quite openly about fiat money and the dangers.
Yeah. What was I gonna say? Oh, yeah. The other thing, aside from the mathematics, is also the geopolitics. And I think that's kind of converging with the mathematics of fiat currency, explosion.
Mm,
And that is like a lot of the global South BRICS or Middle Eastern countries that are closely associated with BRICS. A lot of them are unhappy about what's going on vis-a-vis, let's say, Russia, how they've frozen their reserves, and they can freeze up people's reserves any minute. So I think that's also encouraging central banks like India, Turkey, the Turkish central bank, the Gulf Cooperation central banks, even South Korea now is buying gold
mm.
again, and they bought silver. So I think, yeah, it's like this is going to be really tough for the paper pushers to stop. And you wrote recently, I'm just going to have a look here on your Substack on the 29th of November, an article entitled London Silver Slab Slips Now Heading Down the Mountain. I'm not, is there something else you want to touch upon before we go into this article?
No, I just think, and it touches on the article as well, is
Yeah,
that the holders of these cash immediate ownership contracts in London,
yeah,
you could liken it to standing on the edge of the Grand Canyon, and you're standing on one side, and your metal is far off in the distance on the other side. And
yeah,
that's the situation that we're at right now. Is it's kind of an insoluble situation, it
yeah.
appears, Mario.
It's the allocated, or even the and maybe, yeah, that's what I want to ask before we go into your article. Could you tell the viewers the difference or what allocated and unallocated mean in the LBMA?
Sure. So the allocated is metal that is segregated and that is held against the contract. The unallocated, which is the vast majority of it, is in which let's say there's a pool of 1 ounce of gold or silver, and there's 100 claimants to it, and the whole system was constructed to rely upon that the gold would never be asked for in sufficient quantity to reveal the fact that they didn't have the metal. But this is the problem of, and that goes to the silver slab article, is that we saw, in January there was major hiccups, and then in October there was a disruption of trading as enough investors were asking for metal or trying to acquire the metal that the market had a seizure. And this shouldn't be in the world's largest gold and silver market. So we saw the vault bottom in London back in on October 10th, and they've added the latest numbers that we've seen is they've added 54 million ounces of silver since then. But the nature of the contract and the features of it are such that they haven't solved the underlying problem. They've just band-aided it for a short period of time, but the underlying leverage issue still remains.
Yeah, how much leverage would you say on the unallocated side there is? Like how many claimants per ounce?
Well, they don't, and they never have disclosed the open interest, the open claims, and the reason for that is that the market would fail if they did so openly.
Yeah, the other thing I noticed, David, because the LBMA website, I used to go quite regularly on it to to
Yep.
check the prices, and they had a really good page where you could see the fixings for gold and silver all the way back to 1968 in
Right.
dollars, pounds, and euros. And that was free. But now, one of my viewers told me last Sunday that you have to pay for that now. And I thought that was strange. Less transparency again. And I'm also hearing, David, that uh, a lot of people are unhappy, especially with the LBMA, with COMEX and the bullion banks, and that we could see a lot of lawsuits coming up, but that's a different topic. So maybe you could talk about your silver slab slips. I thought that was really interesting because usually, like the bullion banks, their forecasts for silver prices are very conservative or and very gradual, but you seem to think things are changing now.
Yeah, so I mean, a leveraged Ponzi scheme, once the public becomes generally aware of it, it fails extraordinarily quickly. And you know, looking at something called criticality theory, which is I touched on here, it's that these complex systems, interlinked complex systems in nature, but you could argue that markets are natural systems too. Um, they tend to fail very rapidly once they do start to fail if there are imperfections in them. And the problem that we have with our monetary system and our market system globally is that it's been basically taken over by the central planners who intervened in the market. Um, they intervened with their fiat gold and fiat silver trading system, these unallocated promissory note contracts, which have been created and traded to the moon. And so we have this criticality theory or criticality theorem feature now that I think we have a failure in the market, and that the market now has become aware of for silver exactly where the market bottom is with that failure, that market failure on October 10th. And so what we can expect now is with time that there is a general move to vacate this market. I would expect to see over time a slowing of the trading volume and a gradual exiting of the market. You know, if you look at the game theory of this, it's a very awkward situation when you've got the scale of the leverage that you have in London. And I would liken it to a room with, let's say, 500 people in it, and then a few more realize that there's going to be some kind of an event, and maybe 10 of them can make it out of the room. And the question is like, how do you vacate the room in a way that to ensure that you can get out, given the very difficult odds? And you know, make polite conversation on the way and kind of saunter towards the exit is the approach that you want to take. But the problem that we have is that this was like a trumpet being blown first in January and then especially loud in October, advertising the failure of this market and the fact that the vault bottom is much closer than most had ever anticipated. Even the sleeping investors and funds that actually held these contracts, and you know, the LBMA talks about how efficient they are and how most people tend to hold them because there's not they're substantially cheaper than holding and owning allocated metal in a vault. And there's a reason they're so cheap. It's because there isn't any metal. And so this is the place that we're at now, in that you know, we have kind of a general attempt to move towards the exits, but I would expect that the vast majority of the players recognize that if they rush, they're not going to make it. And I think that perhaps a week ago with the suspension of the COMEX may have been advertisement of that fact. But certainly, I think people would recognize that by now. And then the question is, how do you secure metal from alternate sources? How do you, you know, get out of your paper position in London if you can't take delivery there? How do you get the cash and how do you get this metal elsewhere? And that is the big question that we're going to watch playing out over time now. But it is in everybody's interests not to create a panic in the market. But the sheer scale and the sheer leverage that's in the market speaks to the fact that not everybody and not even the majority of everybody is going to get out of this market, and the scramble has begun, Mario.
Yeah, I guess the mainstream or the bullion banks, they don't want to yell fire in the cinema because then,
Right.
yeah, it would
But
be
that
like,
has happened now
yeah, with
firsthand.
what
October.
happened last week, and also
Yes.
in the beginning of the year, for the viewers, there was a 4 to 8 week delay for delivering spot gold in the LBMA.
Yeah.
And what happened? I forgot what happened on October 10th again, David, regarding
Hour
silver.
and a half cessation of trading in London
Oh yeah,
market.
there was huge backwardation, wasn't there, as well?
Yeah. Yeah.
Yeah.
So we don't know what the details are behind that, but the fact that the world's largest gold and silver market, the cash market,
Well,
suspends trading
yeah.
because of lack of liquidity is an issue.
Yeah, when they say liquidity is basically they don't have any silver. So,
Yeah.
yeah,
And the players in the LBMA as well, Mario, that they have vaults globally, and surely you can source enough silver from these global vaults if the silver was there, and negotiate some kind of a deferred delivery. Um, and the fact that the whole shebang comes to a halt is illustration of the scale of the problem that they have. I would expect more of this.
yeah, no, I agree. And then one day, like the with criticality theory, the avalanche will just wipe out the whole
Right.
system, I guess.
Yeah, the criticality theory, on an avalanche example is that this if you're in the Alpine, you can see these snowfields and they look stable. And it's amazing at times how they can be set off. I've done that skiing myself, not on a grand scale, but on a lesser scale, or even throwing rocks to try and trigger some of these corniches to come off and trigger these avalanches. It's quite amazing to watch, and it's always been a visual, real life impression that's been embedded on me from those experiences, and I can't help but think about it when I look at these metastable systems, stable until they're not, and once they crack, the problem mushrooms. And I've got to believe that this mushrooming problem and the fact that we're dealing with a problem that has exponential growth in terms of the demand implications of the growing demand for delivery, faced with a gradual linear solution, speaks to the fact that this slide in the market is going to continue and accelerate as we go forward, despite the narrative that we're given by many of the bullion bank observers out there.
Yeah, you told me one of the Canadian bullion banks before we started came out and forecast silver at $40 for next year. I mean, uh, that seems like just ridiculous to me.
Well, it could be a Christmas wish list, perhaps.
Yeah, that's right. I remember Bank of America earlier this year when silver was at 38 or 39. They were saying, "Oh, we're gonna see silver at 42 next year in 2026." And some
Yeah,
people who don't believe in the manipulation theory, they said, "Oh, there you go. There's proof that they don't manipulate. They're bullish."
yeah,
But here we are in on December 5th, and we are almost at 60. I mean, we got within like 70, 60 cents of 60
yeah,
before they came in and bombarded the market with paper. But something interesting you said in that article about the avalanche and the slab is that it's impossible in such an environment or situation to try to forecast a gradual rise in the price of silver. Could you elaborate on that and what kind of price you think we might see?
Well, I think it's impossible to forecast where the avalanche stops. All you can say is that this system is in failure. And I've used the analogy before, the roof's on fire. And trying to predict the price going forward a year or 2 years is trying to predict the result of, like, I see the system now is rapidly failing. And this isn't a temporal supply demand imbalance, which is now being met by higher prices. I look at that, the global capital markets at $270,000 billion of assets in the global markets, and that we have available to the market $80 billion of silver every year. And I would argue that the industrial demand is going to become greatly diminished, and you're going to see an explosion in investment demand as this goes forward
Yeah,
in terms of,
270 trillion, isn't it? I think you said billion,
yeah,
but
oh,
yeah,
sorry, bill, yeah, 270 trillion,
yeah,
270,000 billion,
yeah,
right? $270,000 billion versus 80 billion of silver supply,
yeah.
right? The math just doesn't, there's no resolution to the math imbalance there. And the mismatched nature of the problem and the solution speaks of uh, the potential for enormously higher prices for these markets to start to move in a smoother fashion. But the entirety of this situation has been created by creating central planning structures, by having the Bank of England create the London bullion market and create an artificial price fixing system back in, I guess, ultimately in 86, they were given authority. And then Greenspan went to the Fed in August of 87. And in December of 87, the, uh, the LBMA was incorporated, and we saw the rule book and um, what they called the NIPS guide be created thereafter, headed up by the Bank of England and one of the senior traders at Rothschild Bank. Right, this is a creation of the City of London.
Yeah, and Comex cooperates quite a lot, doesn't it, though, with the LBMA?
Well, they're interlinked in the fact that
Yeah,
these bullion banks that are selling futures contracts open those positions by typically going long in London. That's allegedly the typical mechanism, right? So they are joined at the hip in that way, and that you can't do one without the other if you want to say you have a matched book.
yeah,
But the problem that the COMEX position holders have is that as it becomes clear that their offsetting long has no value, they still have their offsetting short in New York that has to be met. And all of a sudden, your matching book becomes uh, terminally mismatched. And now you've got to, in that way, they are related. And in that way, the silver market speaks to a real problem for both of those markets and the bullion banks that have been using them over the decades.
yeah. Um, I mean, to me, it seems that to take profit with your physical silver and even with the miners uh, in the next year or two is crazy because from what you've told me, this is a terminal thing. And do you really want to take profit for a terminal or a fiat currency or a system that's failing? It's almost like back in Venezuela, I think 2017, 2018, taking profit on your gold trade versus the local currency,
Yeah,
you'd be wiped out by now. Is that the way you see things too?
absolutely. And keep in mind that when they had the Bolivar crisis there in Venezuela, the people were buying a month's food supply for 1 ounce of silver. And this is how fast humanity returns to sound money when the paper regime burns, as it always does. And Greenspan himself said that. He said that, I can't remember the exact quote, but it was to the extent that ad extremis, fiat money is all fiat money always fails, and gold is always accepted.
Yeah.
And that's that is true. And that's where we are at now, is that these units of money, gold and silver with their 4,000 year history, um, appear to be well embedded in the DNA of humanity, and that we always return to sound money um, when the concoctions of these central planners fail, as they always do. And one note, Mario, that often people talk about using gold and silver to barter, and I really I take issue with that term, because gold and silver are money, and all they are doing is returning to payment with money, as opposed to payment with with a government fiat creation. And so we know that these fiat creations fail, and this is just a natural return to sound money exchange. And that, I can tell you, is going to be the battle for the next 5 years here, is that they're going to fight hammer and tong to prevent people from returning to money. And they want everybody, from the fiat plantation, they want them now moved in an orderly fashion into the digital plantation, with their digital IDs, digital currency, and social credit scoring. This is really, I think, the realization of a centuries long dream here, in terms of rounding up humanity, and putting in place a system in which they can be dictated to.
Yeah, I'm 100% in agreement with you there. I think they will fail because hopefully the public will wake up and realize the people who designed a system that failed miserably, they want us to believe they'll bring in a really good system now. And that's one of the reasons why I make post the videos that I do on sound money and gold and silver. And yeah,
Not,
yeah, I wanted to,
not only created a system that failed miserably, but rigged a system that failed miserably.
yeah, that's right.
Like that's quite a step, actually.
Yeah,
One is
and
error, and the other one is you could argue a criminal mindset in the end.
yeah. I mean, fraudulent systems always have to be rigged, and the digital farm system that will have to be rigged too. So, yeah, David, it was great to talk to you again. And yeah, I think we're in for interesting times, and I'd like to wish you a very nice weekend.
Thank you, Mario. To you as well.
Thank you.